Welcome to Frankfurt, welcome to Germany. Good to have you here, and I'm sure you'll probably have some commentary on what Richard just presented in terms of construction lending. We'll get into that in a second. Maybe just for everyone to get to know Greg a little bit better. Greg has been in the industry for over 40 years. He started as a managing director of Salomon Brothers, set up Prima Capital over 30 years ago. I'm very excited to have him here as one of, I would say, the longest serving alternative lenders in the US market. And Greg, to maybe start our conversation, you've been in the industry now for exactly 44 years. You lived through the different cycles, navigated through them, 3 major real estate cycles. How would you describe the evolution of the markets and the lessons you've learned along the way, and particularly how maybe they can be applied to today?
Sure. Good morning, everybody. So first I would say, and Richard said you kind of age yourself by interest rates or vice versa. So he mentioned he started his career and rates were 8%, and when I started, the 10-year treasury was about 15%. And the prime rate of interest was just piercing 20% rate of interest. And I made my first construction loan in 1980, 1981. And so I can tell you, they're not riskless. I wish they were, but my opening job was at Chase Manhattan Bank in their workout division, which was working out construction loans from back then. So we would probably challenge the notion about free lunch. But that's part of doing this and being in the business for a very long time. In the early 80s, the business in the United States was really 3 sources of capital. One was permanent capital, the big US insurance companies who were really good at making loans. Construction loans were made by the big banks like my former alma mater, the Chase Manhattan Bank. And then the loans that didn't fit anywhere else were made by the savings and loans. And it kind of meant that they were the crud of the business. Over time, that evolved, that changed. The savings and loans had problems. The markets evolved, and we got to the early 90s. There was a great expression, stay alive to 95. There was also a bank in North Carolina, Charlotte's home, NCNB Bank, which was North Carolina National Bank. But it was more affectionately known as no cash for nobody, because that's what the capital markets were like. And so it's not so different than today. Then we had the markets erupt. We had the GFC, and actually before that we had when the savings and loans blew up with the Resolution Trust Corp, the RTC, and that became the forerunner to the commercial-backed securities market, CMBS. And now we are where we are today, which I think we're going to get to because it's interesting times.
Oh. And coming back to the current state of the U.S. real estate market, I mean, certainly we're reading headlines over here. I remember I was meeting with your CIO actually the day after Silicon Valley.